All right. Very good morning, everyone. This is our final lecture recording for this term, and I know a lot of you are uh, almost desperately waiting for the semester to get over, and one can totally understand the reason why. You've had, I think, most all of you have had a very testing and challenging semester, and I think at the same time it has been one which has kind of reimagined the usual understanding of how teaching generally happens. We've I think spent predominantly most part of our term in the semester interacting virtually, and I think most of the times when we are having even those live interactions, I can barely see or hear most of you. So I have a couple of important points of information for all of you before we get started with the final lecture, which is going to look closely at the great financial crisis of 2007-2008. As I first of all mentioned that usually when we're studying crises, we're looking at a number of events, and ideally speaking, as the way the course was structured, when you do the simulation exercise, the simulation group assignment, you get to be almost role playing and responding to a crisis event as well. So we've not been able to do a few of those collective learning tasks, but what I would suggest is for those who felt that there was some interest that you gained over a period of time in learning more about economics, particularly macro centric issues. There is a course that I offer, which is a course on the brief history of economic crises. I'm still not sure, but there is a possibility that if an elective that I'm hopefully offering in the next semester, of course from another school, if that's cross-listed, uh, it could be one of the courses, which is the brief history of economic crisis. So for those who are interested, can probably audit the class, even if you're not eligible to take a cross-listed course. So there you would in fact get a bit more close on understanding what we do, because that's a course constructed around discussing crises. I will, however, in this particular lecture, start by taking a look at some of the aspects that we discuss in that course. So I have taken the liberty to do that, given the fact that this is perhaps the only session we're having on a specific event of a crisis. Now, as I said, there are a couple of points of information which are just kind of the housekeeping or rules, which is important. The first, which is a very important piece of information, which I mentioned earlier, and let me reiterate that, is with respect to your end term uh, take home book review submission assignment. All of you are required to upload your respective submissions via UMS platform before 3 p.m. 15th of June, which is basically a Monday. I would strongly suggest that you do that a few days before the scheduled deadline for technical reasons or simply to get done with the assignment. I have scheduled, based on our last interaction, a specific time slot for our forthcoming and final live interaction, which is going to be on the 8th of June, which is a Monday. We will start with a discussion from 8 a.m. It's an early morning kind of interaction, but it's our final one. So I hope all of you can attend that. From 8 to 9 a.m., I will be taking all questions specifically with respect to your book review and term submission. Any question or any doubt that you have, you should clear those up right then. Let me kind of clearly emphasize, I won't be responding to individual emails all the time. I mean, I think this exercise of just having the liberty to drop in an email and expect a response at all points of time is not a fair one. You need to learn how to have proper interaction at the time when it is scheduled to do so. So Monday we're doing that from 8 a.m. to 9 a.m. From 9 a.m. onwards, we'll start with a discussion on any queries you've had with respect to the lecture, and then we can go back again to any discussions or queries you may have with respect to your end term submission. Um, uh, uh, Of course, I mean this is excluding the fact that if there is an email which is sent, and you must be seeing, it's not as if that all emails are not responded to. In fact, I respond to 99% of the emails that you send me across within, I think within 24 hours is the rule that I have. But if you don't receive a response, and I think if it's a matter of great emergency, you can probably resend the email again. But avoid with these questions on how to approach your assignment, how to write the assignment. Am I going the right way? Am I taking the right path? It's an end-term submission. If you've not understood the drill by now, I don't think you'll be able to do that again. One thing I would definitely want to point out is the fact that the inability for each one of you to have had a independent feedback on each of your chapter reviews. I offered you a set of responses and comments in our last interaction, which were on your chapter review submissions and basically directing you how to approach your book review submission. I think that was a very important discussion. You need to take a look at those points. Most of you, as I mentioned in our interaction, were facing challenges in addressing those points. So I expect you to do that. What you are, and the second piece of information that I had to give to all of you is the fact that we are. So I think the examinations office informed me that there's an issue in uploading marks on UMS out of 50. So all instructors are required to upload the final grade, which is basically out of 100 on your EMS platform. So earlier, my plan was to upload your marks, the total internal marks out of 50, which is for your class group presentation exercise plus your chapter review submission. So I think on UMS, it won't be possible for me to upload. What I am going to do, however, is will be sending you an individual email to each one of you with the breakup of your marks out of 50. So I'm going to do that over this weekend. You'll receive an email from me on Saturday or Sunday because I'll be sending out the grades one by one to all of you. So please watch out for that. You will get a grade mark out of 50, which is your total grade, and also what have you, how well you have performed in your presentation exercise and your chapter review submission. So these are the two things that I wanted to suggest. The final thing, which is I would probably want to urge a little bit towards that, so that I don't end up completing an entire semester without being able to know who's who. So I would request that in your last interaction, which is scheduled on Monday morning, all of you please have your cameras open for the entire length of our interaction. You may have bad internet or whatever. I mean, if that's an issue, that's another thing. But please have your respective cameras open, which will just help me at least know who's who. And I mean, of course, I know a few of you, but I've not had a chance to be able to have a more holistic idea about each one of you with your names. So sometimes I'm confused a little bit with that. That's perhaps the first time that has ever happened in me teaching an entire course. So I don't want that to happen as we complete the semester. So these three things which are very important that I've mentioned. The first thing is the fact that we're going to be taking all queries with respect to your end-term book review submissions starting at 8 a.m. till 9 a.m. on Monday morning. I expect all of you to be there. All your queries should be directed then. Please avoid sending any emails thereafter. I think that's good as well, because then you have all the time just to work and finalize the review instead of kind of always be in a confused cycle of what to do and what is expected. The second is the information regarding having emails sent by me on your overall grade, which is your internal grade out of 50. You won't have the grades put up on EMS, but you will have it sent across to you by email from my email ID. So I'll do that over this weekend. That's Saturday and Sunday. And the final point, which is what I've requested you, is please have your respective cameras on Teams switched on for the entire length of interaction we have on Monday, so that I have a chance to at least know who's who. Okay, with that, we'll get started with our lecture interaction for today. This is one of the rather more important topics that we discuss over the course, and I think it's a good way to probably bring the cycle of our conversation to an end with the course on macroeconomics, because a question which is often asked by many students or those who are learning economics is, all right, of what use is macroeconomics as a discipline? I'll in fact address that question towards the end of this presentation with some uh, mixed degree of pessimism and optimism. But the optimistic take would be that, well, macroeconomists taking a bird's eye view of the economy have a tendency to be able to understand the markers or indicators which help you, in a way, judge or adjudicate the health of the economy and how well an economy is performing. So that's something which I mean, mostly macroeconomists have a better tendency to do that. Why is that I say so? Is simply because of the fact that when you've had economic crises in the past, our ability now, let's say in the 21st century, and I think the current COVID-19 and the economic crisis that has followed it is a classic case in point, is that we were better equipped to respond to an economic crash like this. In fact, despite the unprecedented nature and the scale of the pandemic and the crisis, the health shock and the economic shock, still, whether it's monetary policy or fiscal policy across the world, everyone has, or all institutions have gone to go all the way out in most countries to be able to respond to the crisis. And the reason for that is precisely because of the knowledge gained from handling crises in the past. The United States, for example, way back in the late 1920s, during the Great Depression, was very ill-equipped to deal with a crisis by having any form of government intervention. That gave the Keynesian school of thought a kind of, a new beginning. That's why a lot of people call the Great Depression as the holy grail of macroeconomic thinking, because macroeconomics emerged as the economic discussion that was happening around addressing employment, the role of government spending, how volatile private investment is or animal spirits are, how to revive animal spirits, what role can government play in increasing jobs, because those were the questions that the crises had imposed. And from then to almost now, you see that the Federal Reserve and other institutions, including the IMF, for the IMF, for example, handling the 1996 East Asian crisis was a big challenge, and that offered it a lot of lessons to be far more, equipped. In fact, right now the IMF, which is 189 member nations, has had almost more than 100 nations for the first time in the entire history of the IMF applying for debt relief. Debt relief basically all cancel all debt or suspend all debt payments of member nations, particularly developing member nations who owe IMF money, and that's something which the IMF perhaps has never dealt with at the same scale. Consequently, at the same time, because most crises, as you know, are regional in nature, geographically concentrated in one particular area, and the impact of that is felt more there. Just going back to our discussion earlier on the idea of the international macroeconomic policy trilemma, every country or nation is faced with three policy choices, and they can probably take two as options to pursue and leave the other one around. I hope this part of our discussion was clear. Whether it's capital mobility, fixed exchange rates, and independent monetary policies, there are different lessons that we gather from the evidence of history from the past on how countries have been able to ensure capital mobility with fixed exchange rates. That was during the classical gold standard era between 1870 and 1914, the Bretton Woods system, which emerged from 1945 to 71, where there was a dollar to gold parity managed by the Federal Reserve in the US, and allowing a relative degree of autonomy to countries or nations to pursue independent monetary policy, even though most nations were very closely entwined to know what the US monetary policy was, because of the because of the dollar being the reserve currency for a lot of trade. Post 1971, we saw the emergence of a free floating exchange rate system as a result, which allowed a greater degree of autonomy and independence for monetary policy action, fiscal policy action, and to pursue a greater degree of capital movement at the cost of fixed exchange rates. So that's the kind of journey that the international monetary system or international financial system has made. Now, we're going to look at three questions for our discussion today. And I think the length of our lecture is going to slightly increase in terms of time. So I would request you to keep a close eye out and look at each of these questions very closely. We're going to identify the key factors that led to the subprime financial crisis. So I'll come out with the causes, but we'll start by, in fact, the second question sequence first, that is the effects of the crisis in the US and other countries' macroeconomic fundamentals. What did the 2007-8 crisis mean? How did it impact the US? Why is it called the Great Recession? Because the terminology of the Great Recession resembles very closely the Great Depression. It's just that the Great Depression was much longer in time, much more severe in its impact, and had very little involvement of the government in helping financial institutions out or affected industries out. As against the Great Recession, which saw much greater involvement of the government. The third question is the lessons that one tends to learn, which are more theoretical in nature, and at the same time more experiential and connected to the teaching and learning of macroeconomics. This is an interesting quote that I often use even in the crises course by starting a discussion on what Keynes said about the Great Slump or the Great Depression of 1930. And let me read this out as a very powerful imagery and a reflection on the state of the socioeconomic conditions around that period of time. This kind of tends to reoccur and replay itself with every crisis, and I think it's a very powerful passage from Keynes' text. So Keynes says, this is a nightmare, talking about the crisis of 1930, which will pass away with the morning. For the resources of nature and men's devices are just as fertile and productive as they were. The rate of our progress towards solving the material problems of life is not less rapid. We are as capable as before of affording for everyone a high standard of living. High, I mean, compared with, say, 20 years ago. And will soon learn to afford a standard higher still. We were not previously deceived, but, and this is the important part, but today we have involved ourselves in a colossal muddle, having blundered in the control of a delicate machine, which is basically the economy that Keynes is referring to, the working of which we do not quite understand. The result is that our possibilities of wealth, I think, let's look at this closely. The result is that our possibilities of wealth may run to waste for a time, perhaps for a long time. You can use these last three lines that Keynes has said to almost any situation of an economic or a major economic crisis that has happened ever since, even today or now, saying that our possibilities of wealth may run to waste if we don't learn to handle the machine or the economy more delicately. So one could say that that's the case for countries that have really messed up with their handling of the coronavirus. I mean, India would be named definitely as one. It had a nationwide lockdown. We saw the crisis of what it did to workers generally. We saw how did it impact, or how it has impacted the economy, how it has flattened the economic curve or economic performance curve very much. And some would argue that maybe it was needed for the period of time, but whatever it is, I think the situation of where we are says very clearly that the facts of the case present that a 2-month or a 2.5-month lockdown has not yielded the same amount of dividend that we were anticipating that it would. Let's say for the fact that if we had put the lockdown in place, the virus would go away, or the infection rate would or spread of the infection would stop. I think that hasn't happened. Still, we have a high number of cases. Yes, maybe the containment would have been stopped, but what damage has been done to the economy is far, far longer and severe as compared to any other situation in the past. Now, I want, and this is something which we start with our economic crisis course with. We start by looking at the behavior of economic crises far closely, and then looking at the evidence from past history by taking separate episodes. I'm not going to look at episodes from the past. Of course, that's a very different, I mean, it's a long journey, and looking at, it's a different course to completely begin with. But let me include our discussion on some important crisis behavior attributes that feeds into an economic shock or that feeds into an economic crisis. So what are some of those behaviors? And let me go by one by one. So one of the things that you would have probably learned even in a basic course in microeconomics is the fact that there's something what we call as demonstration effect, or the ability of individuals, humans, to respond or react to a situation or shape their preferences or economic decisions or social decisions based on what others are doing. If others are acting in a certain way, if others have a iPhone, you might be induced in buying an iPhone as well, to be connected with your friends, or just basically try the machine out. Now that's demonstration effect, and that happens even in series of economic crises. If you see 10 people around you running to a bank to withdraw their money from the bank, and they anticipate that the bank is going to shut down, or is it likely to not being able to repay or make others to withdraw their money at the same time, it causes a panic, and that herd behavior makes people to panic as well. And that's how you see a run on the bank being caused. In the same way, what you're likely to experience and see in the stock market pretty much is very similar. You see, let's say, a bunch of shareholders selling off their stock, and leading to a lot of short sellers also selling off the stock of the same company. And by mid of the day, maybe others who were not planning to sell the stock of the same company, but seeing the behavior of others and the change in prices, or just basically the crashing down of prices of a given stock, feel that they need to sell the stock now before the price becomes too low. So all of these are good examples of herd behavior, and they may lead to an exacerbation of larger crisis in hand. The second element, which is very behavioral, is this need to maximize self-interest. And it's almost like a behavior where you tend to monopolize economic decision making, and you narrow down competitive behavior. You do not act in the interest of, let's say, thinking about others, and but rather maximize or serve your own interests, needs. This could be, I mean, the classic case is that of a war, right, a political conflict. If Trump, for example, feels that an anti-China stand is popular for him in his own re-election campaign, he is going to do that, irrespective of how important it is to have a strong economic interdependence with China, or how important it is right now to reflect or demonstrate as much of cooperation as you can, because everyone is kind of hunting right now for a vaccine. So even scientists need to communicate with each other as much as information as they can, which can help in the development and spread and distribution of a vaccine. I mean, hypothetically, imagine the case if the first vaccine to cure the virus emerges in China, and you already have a severe political conflict in another country. So of course, your ability to kind of have a better partnership is constrained or impacted. So maximization of self-interest, or almost a very narcissistic behavior, often monopolizes decision making, and it costs or has a serious ramification, which would be not political or sociological in nature, but also economic. The third key factor is between profitability and risk. You see a sign which is in between, and I believe you would have. Uh, I'll just pause for a second for you to think a little bit about what this sign represents. So if by now you've not been able to recollect, this is a sign of what we used to study under the concept of congruency in geometry, whether the triangles are congruent to each other or not. So whether the pattern of size and shape and form is more or less aligned or not. That's what congruency means and allows for. Congruency does not mean equal, and that's important. It means in the same direction. So there's a certain sense of proportional alignment. So why congruency between profitability and risk is, if my quest as a firm to maximize my profit involves me to take higher and higher and higher risks, I am more going to be more vulnerable to a crisis shock or a shock hitting my business. So there's often this need to mitigate risks. But the more risks you take, a lot of times there's a higher degree of, depending on what you're doing, there is a higher degree of profitability that you tend to gain. I mean, again, financial market or the stock market is a good example. More risk taking you are, you can make maybe big buck on your investments, but it also at the same time you're equally vulnerable to losing out predominantly a lot of your wealth if tomorrow some kind of a, that risk taking ability has some kind of a negative impact. So that's the another attribute which often results in a crisis environment. So I mean, imagine, for example, and just look at each of these attributes as something, if that resonates from one individual to the collective, so from one person to, let's say, a million, because one person acting in some way, unless he or she exercises a great degree of political power, would not result in a crisis for the entire set of citizenry. But if all people are acting in that regard, you will feel and you will experience a crisis. So the first thing to look at is for demonstration effect. You can say that that's something which makes a lot of people act in a certain manner based on what others people are doing. The second is the situation of a maximization of self-interest. If that's the ultimate goal for you to decide all your actions, all your self-interest, all your actions are guided by your self-interest. And that self, basically, that we used to, I think, remember we had a few sessions around this, that self largely considers your own ego as a way to see. There is an image of your own self that you consider needs to feed into every action. And that doesn't have any collective interest of any other people brought under the action of well-being. The third is the element of profitability and risk. If your quest to have higher profits is congruent or is proportionate to taking more and more risks, you're more vulnerable to a crisis. Short-term versus long-term returns, I think that's on actions for everyone. If you have a political party or you have a government, you have a firm which is principally guided by short-term interests and short-term motivations, it may result in some kind of vulnerabilities over the long term. In fact, that's why you'll find it the question of sustainability that has really emerged in not only development studies or ecological context, but also in production, consumption, and distribution, is because it talks about long-term costs of your immediate actions. So to be sustainable in its behavior, you want to be as long as possible in your thinking and your planning, as against be guided solely by short-term interests or short-term motivations. So if you're guided too much by short-term interests and motivations, you might result in a crisis very soon, right? Collectively speaking. Circumventing the regulatory rationale means bypassing the law. If there is a law which is, prohibiting certain action, let's say regulation on financial markets, you're trying to circumvent the law to be able to make money, that is not only criminally liable, in the sense that you may not only be indicted or maybe prosecuted for that, but at the same time it also in a lot of times create a crisis environment, or an environment where the crisis is most likely to happen. Now, there are two very important concepts which you often come across in microeconomics that are very important with crisis behavior as well, and I'll just explain them in more brief details. We discussed them a lot more in insight and in depth in the crisis course. One is the concept of information asymmetry, and that's something which is really a big problem even today in the digital economy and landscape, where everyone has access to a lot of information. In fact, that would create a lot of asymmetry as well. You may have access to information about a given transaction or about a given action that I may not have, and that may, as a result, lead us to have divergent points of view, very different sets of thinking. In fact, a lot of the polarization that happens, politically speaking, also happens or thrives on asymmetry of information. So I feed you a certain amount of information that makes you ideologically more disposed to a certain belief, while I feed something else as an important information to another person who may be ideologically, opposed to the previous belief and maybe aligned to a contrarian idea. So, and that's where, in fact, a lot of questions have been asked on the role of social media, for that matter. That in your objective of being neutral, or the objective of being unbiased or unprejudiced and trying to provide information as what it is, a lot of times some people may stand to do that as a conscious attempt to polarize thinking and people's thinking systems. So even in case of financial landscapes or ecosystems, information asymmetry is a big concern. I've given earlier the example in class about if you're having a transaction with a diamond seller who's selling a necklace, and you make the transaction in check, but you are aware that you don't have enough balance in the account for the check to go through. Maybe the vendor or the merchant takes the check and gives you the necklace, and you may end up kind of running away with the necklace, conscious of the fact that you didn't have enough money to pay from the account. Now the check is likely to bounce when it is processed for payment, and the merchant is likely to realize that this was an act of fraud. Now, there, in fact, in that particular illustration itself, there's some information asymmetry. I had more information about the transaction based on the knowledge that I didn't have enough money in the account, as against the other vendor who accepted check as a payment mode, assuming the fact that I was, already aware that I had enough money in the account. And that's why you'll find when the check bounces, and a lot of times, or in any transaction, in any conversation, it leads to a significant penalty that may be asked as a part of the penalty fee for the bouncing of check, because it is seen as not a good practice for financial transfers or payments. There are legal asymmetries as well, that is in the interpretation of the law. And this happens, I mean, what better way to understand legal asymmetries than look at the numerous MHA orders that have been coming out with the situation of the lockdown. This whole categorization of the red, green, and orange zone that was happening created a huge trouble of interpretation of how and what areas are open, what are not. Can industries allow for movement of vehicles within certain areas, not within certain areas? How would transportation of goods or raw materials happen from one space to other? That has had massive ramifications of the supply chain aspect. So there are issues with law as well, and the interpretation of that law and the text. Moral hazard is a big concern in crisis environments. Sometimes the understanding is, the very simple example, what moral hazard means is, if I bought accidental insurance, and I'm insured against my car getting damaged from accident, maybe I may tend to speed a little more, because somewhere in my subconscious mind, I feel that, yeah, I'm paying up for insurance. Yeah, let me test the speed of the car. And tomorrow, if there is just in case there's a crash as well, I'm secured for. So moral hazard simply means that your risk-taking powers may go up, assuming that you're covered for that risk, or when you're covered for that risk. Another example, which is often cited in international development literature of moral hazard, is on the role of aid. If a country is used to receiving a lot of aid from a developed country for improving its economic performance, sometimes, given the fact that it is receiving that huge amount of aid, its incentive to actually undertake economic performance may be adverse or negative, simply given the fact that if tomorrow it progresses economically, there is a chance that the aid may be withdrawn. So to avoid that situation, to avoid that scenario, a lot of countries prefer being in a certain category. That was, in fact, the argument that Trump has had against China and India, that in the WTO, both of these countries have been categorized, quote unquote, as developing countries, as a result of which have been subject to great concessions and preferences in the trading rules of the game. So that issue of moral hazard tends to really play out in economic crisis environments. One major kind of bone of contention has been if banks fail or collapse because of their own mistakes, because of their own bad lending habits, why should the government bail these banks out? Because that may induce moral hazard. That may make the banks uh, undertake more risk-taking behavior, undertake more bad debt accumulation, undertake more bad lending practices, because banks may have this understanding that, well, if tomorrow something goes wrong, governments are going to come and bail us out, because they don't want to see a bank collapse, simply for the reason that may lead to a lot of people losing out on their cash and money. So moral hazard is a big question that tends to come in studying or understanding crisis behavior. The final point, which is very closely connected to the second point, is that of rationality, sans or without reasonableness. And that's largely a big question in economics and the understanding of utilitarian economics itself, that most of our economic thinking, particularly in the neoclassical school, has been too much utility centric or individual centric. So when you're talking about individual and utility centric, you're seeing the individual and an individual self-interest maximizing idea very much concentrated to the individual, and not seeing the individual as part of a larger ecosystem or a collective. So I'm rather happy destroying the environment, doing whatever it takes to maximize my own production, to ensure that my profitability margins are going up, my sales are going up. But I may be doing that in a negative mm, negative or the concept of externalities that we were looking at. My actions would maybe causing higher amount of negative externalities, and maybe affecting the environment at large, maybe affecting people at large from the perspective of healthcare, not having the purity to breathe. I mean, just look at this way. How many times in the last few weeks have there been any discussions on oxygen or breathing issues, particularly in, let's say, the NCR region or within Delhi? Simply for the reason because the shutdown of economic activity caused the improvement in weather quality of air to remarkably greater extent. And that may be seen as a positive externality, like in a certain way of sorts of a lockdown. But the negative externalities outweigh the positive externalities, and that's something that we try to kind of always balance between. So a lot of crises may happen because of the fact that you tend to take rationality as more important as being reasonable to people, to society. The question of law looks largely at reasonability. I think that most of you would know. I mentioned this previously in the class as well, that the question of law looks largely at the element of reasonableness, how reasonable you are, how conscious you are about your own actions and the effect of that on others. While in economic thinking, particularly in the neoclassical school, which is very utility centric, the focus seems to be far more on rationality, which is a self-interest maximizing prism, which is much more where the self is almost replaced by the ego, right? So you're looking at your interest, your thoughts, your emotions, actions that help you satisfy you as a person as against anyone else, right? So what happened in 2007-8? Now with this, we get into the impact of the crisis, and just let's get some data points or facts in the mix so that we get some perspective. So I've mentioned earlier in the first slide that the few of the data points that are provided here are borrowed from Paul Krugman, Nobel laureate Paul Krugman's initial presentation that he offered on studying the effect and the impact of the financial crisis. So I've relied on Krugman's work here. You saw that over the period of time between 99 and 2006 and 7, the US real GDP per capita, while it could have gone down, but still stayed at a certain trend line. That the dotted line is the trend line, which is the rate at which US was expected to grow given its past trajectory from 1989 to 1999. What you see around 2007 is the sharp fall in the performance of GDP per capita, which is basically the average rate of growth in income of people. And that's just started collapsing between 2007 to 2009. So it was, consecutive quarters of negative growth. That's what qualifies for it to be a recession. If you have years and years of negative growth rate, it would translate into a depression then. So from 2009, the economic trajectory started picking up, but it was nowhere similar to the GDP per capita level that was projected by the trend based on the 1999-2000 level. So somewhere you can say that from 2006 itself, the decline in growth and GDP per capita in case of the US has not been able to bring the growth level back anywhere remotely similar to the pre-crisis period. In fact, that's been one of the major questions for the US growth story even right now, that the fact that it was not able to go back to its pre-crisis level, and now it has been shut by perhaps the worst unemployment crisis since the Great Depression. In fact, far worse than that. You're likely to see growth levels perhaps never returning to the pre-2006 level. There's a certain weirdness of recessions that is talked about by Krugman, and he says that this is something very important to discuss and understand in a post 2000 context, or in the 21st century. The first thing is that I think Krugman talks about the fact that despite growth not going up, that despite the fact that there is not very high amount of growth in terms of percentage and in terms of real GDP numbers or per capita, you still have seen technological growth continue to progress. So that's true, right? You've seen that with EIT, you've seen that with energy, you've seen that with space, cyber security, automation, better quality cars. I mean, a lot of those things have, despite anything else, despite the fact that growth has not been the same as it was before 2000s, let's say, you still have seen technological growth increasing, and also much more deeply penetrative in societies across the world. The second thing that's a very important aspect to understand is the context of working age population growth. In a lot of industrialized countries, particularly in Europe, particularly in countries like Japan, the working age population growth has been declining. And what it means is the fact that if your working age population growth is declining and you're already witnessing a very stagnant or low growth, your ability in the future to kickstart a higher amount of growth is going to be very limited, because most of the people are going to be in the aging population bracket. They would require pensions, they'd require more unilateral transfers, which will be part of unproductive spending that is not adding directly to the investment or growth capacity of the economy. However, in countries like India, Brazil, you have working age population growth, which is far more promising. So it gives that degree of hope, particularly for industrialized economies, to invest more in these markets, assuming or given the fact that the working age population growth is high. And that's why there's this whole bunch of discussion on how our demographic advantages give us that advantage. But always remember that the demographic advantage or the population growth or working age population growth advantage are temporal in nature. That means it's just 1 or 2 decades where you can really make the most out of it, because every country will grow old, right? That's not something which is going to, so it's not as if that industrialized countries or European countries are only going to grow old or have a significant major population which is in the outside the working age population category, that's above 60 and above or below 50. So that is not the case. India is also going to witness that. But right now, or this period of time, I think the idea is that till at least 2030, at least the next 10 to 12 years, our working age population growth gives us a more promising scenario. So that makes consumption demand to be a very critical factor. And consumption remains high, which makes a lot of other countries to be interested in areas where working age population is higher as compared to the dependent or the senior population. So countries within Africa, right? Countries within parts of Southeast Asia, countries within part of South Asia, all of them which are representing a higher degree of working age population growth with greater amount of possibilities for consumption multiplier effect to be there. Like you have the income multiplier effect. You can almost see that the consumption multiplier effect is if H&M and Zara has opened their outlet in India, their demand may be really high. And given the fact that people are consuming way more, that would give them the boost to expand their operations in these countries vis-a-vis doing it, let's say in Scandinavian countries or other countries where working age population growth may not be that high. The third point is that we're all observing that the capital stock level is growing as well, but not so fast. When I say capital stock, that talks about capital investments that allow for greater growth. So if you talk about, if less and less people are interested in higher education, let me take that example. If imagine a scenario where less and less people are convinced with the idea of getting into higher education, people get disillusioned. Well, I'm doing this degree, I don't get a job, and the job that I'm getting, I can probably do that with a high school degree or with a low educational qualification. So what is that you're likely to see? The less and less capital investments in the infrastructure for universities, or most universities are going to find it very difficult to be able to be in the education landscape, particularly private institutions. The only reason private institutions have been so much investing in the higher education space is because they see that almost as a new market. Invest capital, get good teachers, there's demand for higher education, more people will pay up to do that. But in a scenario which is reverse, you will see capital investment in that particular sector may come down. Now, what you're seeing right now is very interesting. And this is a point which we're trying to closely look at as well, is while the productive capacity has been rising, right, through greater capital investments, the focus has been more on quality of production and less on quantity. And this is something which which you've seen in the post great financial crisis world or the Great Recession world, that many countries have no longer had the interest to scale up production at the same level. It's difficult to contextualize this question in context to India, because we have not reached even a stage where the focus on quality replace quantity. But some sectors have actually gone into that. Automobile is a very good example. So in automobile sector, the focus on producing more cars as against better cars has been changed. There is focus now on moving towards electrical vehicles, or vehicles which are using renewable forms of energy, which seems to be addressing the question of sustainability. So the focus is more on quality than producing the quantity. Now, the idea is, unless and until you don't focus on quantity, you can't have benefits of cost or price attributed. That has been one single most challenge with Tesla, for example. You might be producing the best electrical vehicle and the most, posh, sophisticated, technology-centric vehicle, but if the cost of that is 3 times or 4 times higher than even the most expensive diesel or petrol car, it's going to make things difficult. And that's why the recovery for a lot of economies has been sluggish, because the pattern of production has changed. Most capital investments are going in areas for improving quality or changing the structure of the industry. And the two things that have been responsible is, one, the greater need for discussions on sustainability. So looking at the long-term effects of your business rather than be guided by short-term interests. That's good in a certain way, but that will definitely have its effect on growth. The literature which has been looking at this, and you can probably look at some videos and some readings on this, is by looking into the discussion on degrowth. Like you have deglobalization, there's a lot of discussion on degrowth, which is closely entwined with the sustainability argument. The other element of that is the fact that technology has had such a large presence in the activity of production and distribution, particularly in the platform economy, the digital economic landscape, that the focus on quality quite often takes precedence at the first few levels than quantity. In fact, even competition, or a greater degree of competition in certain markets, allows people to focus on improving their quality of production and then anticipate or get access to more people. So these three are what you would consider, and what Krugman has argued are very important elements to understand why recessions last for very long, A. Second, why even if you get out of a recession, you may not see kind of the pre-crisis growth levels anytime soon, and it becomes very difficult. Another very good example, and for those who might be interested in getting deeper into this question, is to look at the concept of secular stagnation, which was championed by one of the kind of very renowned policy economists in the US, also advising to the Barack Obama administration and during the time of the financial crisis, Larry Summers. And Joseph Stiglitz and Larry Summers got into this huge argument on secular stagnation, whether the concept makes sense or not. But a lot of that has talked about on the need for greater government spending and its own role for boosting growth. So the secular stagnation kind of argument means that because government spending after a crisis slows down, because it feels that the crisis is no longer kind of the same in its severity, and as the government spending starts going down, you see that the growth also starts stagnating. So you're not experiencing a crisis or a shock, but you're also not experiencing a very high spike in growth levels. So it starts stagnating a little bit. And that secular stagnation, as so as to speak, is something that has been seen in the aftermath of the great financial crisis, that is 2007-8 crisis as well. And Larry Summers and I think Stiglitz have been on it. For those interested, can look a little bit at the Project Syndicate website, which was documenting some of the exchange letters between these economists. Now, what did the 2007-8 crash did? And I mean, these numbers look nowhere similar to what numbers we're seeing with unemployment now, but you still want to get a better context, is that after the Great Depression, the massive shock to the non-farm or the non-agricultural sector in jobs came during the Great Recession. And that's why people got really scared and started reimagining what was seen in the US during the Great Depression. So jobs had a huge impact. The short-term unemployment rate went up. You can see by how much. We are right now experiencing in India an unemployment rate of roughly around 30% in urban areas, which is in the unorganized sector. But if you look at the numbers across states, I mean, these are horrifying. States like Jharkhand, Bihar have unemployment rates of touching around above 55, 54. Delhi has an unemployment rate of around 45%. Now, this is in the organized sector. You cannot even possibly imagine the decimation of the unorganized sector, which hires more than 87% of the people in that sector. So in the remaining of that 13%, if this is the high rate of unemployment, you can totally imagine how bad the situation might be. Now, in the US, what you started seeing was that the unemployment situation, very similar to the Great Depression, persisted for very long. Now, this was conjointly connected with this point that I was earlier making, that because growth level did not pick up that much, growth was very sluggish, recovery was very sluggish. There was recovery, you didn't see kind of further falling down of GDP per capita, but the growth never reached at a level where unemployment could go down. In fact, the evidence of unemployment levels going down really come in the last 2 years of the Obama administration. By then, you started seeing some positive effects. In fact, the first 2 years of Trump's administration started seeing the positive effects of a lot of policies that were happening in the first 3 to 4 years of Obama's presidency. And economics works like that. A lot of policies take time to come in, and their own effect take also a lot of time. So they don't wait for elections to show effect. And a lot of the times, the positive effects will be seen way after a person has left, or vice versa. A lot of time, negative effects will be seen way after a person is left out of power. Now, a good proxy for knowing a high degree of unemployment is by looking at aid recipients, so those who have applied for unemployment insurance. Right now, that's the basic indicator we are getting our numbers from in the case of the US. In India, there's no perhaps way. CMIE, which is the kind of main principal source for periodic, frequent, weekly unemployment numbers, does that through almost telephonic calls and surveys. The surveys earlier CMIE used to do was door-to-door surveys. Now, in the age of physical and social distancing, that's no longer possible, and also in curfew-style lockdowns. So a lot of the surveys CMI was doing was through almost telephone calls to understand how many people were going through unemployment. But in the US, actually, because every state almost since the Great Depression has had or instituted an unemployment insurance scheme for those who get become unemployed can apply for this scheme and avail some amount of benefits. So that has been a huge, there's been a huge spike on that even recently. Now, the impact of the Great Recession on a number of other European countries was severe. In fact, as most of you know, the Great Recession then led to the sovereign debt crisis in most of Europe and the Eurozone, which saw countries like Portugal, Italy, Greece, Spain, all collapsing, exacerbating debt. The Irish banking crisis, the Iceland crisis, all of them happened right after this period of time, because a lot of the banks in the European countries had massive exposures of debt to US. And as the US banks started collapsing, they had a spillover impact on many of these countries. The only country which kind of relatively could do better over a period of time was a country like France and Germany, but many other countries were facing a huge recessionary phase right after the crisis, particularly in months right after the crisis. This is a case in point for the different block of countries which use different currencies for a lot of trade. So the sterling block basically is this group of countries, particularly within the UK, which is Ireland, Scotland, England, using a lot more of pounds for trade. Gold block, which tends to use still a lot more about of gold as currencies, and the euro area, which is basically the European group of nations which use euro as the main medium of transaction. So the sterling bloc was very dominant in 1929 to 38. Remember, that is the period of time when Britain was far more powerful as an economic hotspot as compared to the US. The UK kind of got displaced with the US with the Great Depression. And after that, in fact, it was all US kind of taking the lead militarily, economically as a power. So the real GDP levels of the sterling bloc did not, was much higher as compared to what you see in the Eurozone crisis 2007-2015. What this represents is at no point of time the sterling or the gold bloc saw this bad an economic shock or a crisis, even during the depression, as compared to the 2007 and 15 period. So what it means is that Eurozone as a region faced its worst crisis of the century with the aftermath of the financial crisis of 2007 and 8. Nowhere similar was the impact the same as it saw into the Great Depression, even though the Great Depression was bad enough for a lot of people losing their jobs, a lot of protectionism happening. Much of the European region was very less integrated around that time. Even then, you see that the impact of the great financial crisis was worse. This is another chart to give you a perspective, the change in real GDP of countries right after the crash or the Great Recession. Countries like Canada, United States were seeing closer to zero growth rate, but most of Europe actually was seeing negative growth rate. The worst being affected countries like Greece, you see right at the bottom, Cyprus, Luxembourg, Ireland, Italy. A lot of these countries started exacerbating huge amount of debt, didn't have the money to put in the money for greater spending, fiscal contractionary policy, fiscal, monetary expansionary policy was very difficult because everybody was looking at the costs of what may happen to a deeper recession. So as compared to the US, many countries in Europe felt that they were far worse off for a far longer period of time as compared to any crisis in the past. So what are the main causes for this crisis that happened in 2007 and 8? And one major aspect, I think was most of you would probably know, is the housing price bubble crash, or the fall or crash in housing prices that happened around 2007 and 8. Now, why was this important? Because most banks were closely hedging or betting a lot against a rise in prices for houses. They felt that American economy was benefiting significantly by making Americans buy more houses, have more people constructing more houses. So for the economy, that was great. The real estate sector was principally responsible for the boom period. And you see that boom period coming into from the 2000 to 2006 and 7. The price rise in housing allowed for banks to deregulate, lend more money, people to buy more houses. Most people had this feeling that if the banks are willing to provide me a cheap loan, the banks would be knowing what they're doing, and I'm willing to put my earlier home on a collateral and buy a new home. So what banks were doing is that they were taking as as collaterals, they were taking securities in the form of the real estate sector, which is either land or house, and they were lending out primarily for people to buy more houses as well. So I'm putting a house to buy a new house. At the end of the day, if I'm not able to pay money for the loan that I have taken to get this house, I default on my loan. So the bank then has a house to be able to sell off as a security. What happens if a bulk of people default at the same time, which happens in the case of subprime borrowers or borrowers which are most likely to default? If I'm giving out money to the same set of people who have not paid their credit card bills, have had huge history of defaults, I'm likely to see a high rate of default from them, as against those who are seen as safe borrowers who pay their dues on time, pay their EMIs, and that's not a problem for me. So the deregulation wave, or the financial deregulation wave that started under, I think, the Bush administration, first out of the Bush administration from early 2000s, the Federal Reserve chairman at the same time was Alan Greenspan, who was seen as this, champion for deregulation, allowing for market forces to completely reign and self-correct over a period of time. So everybody expected that the rise in prices in housing gave everyone this push, particularly banks, to exercise as much of lending as they could, bottom feed their credit requirements. That means not put too much of constraints on people on whether you can take a loan or you can't take a loan. You're looking out to buy a house, I'll give you a loan, irrespective of looking at much of your prior records. So the subprime borrowing levels really gone up, subprime lending had gone up, and banks were getting richer and richer till the time that the housing prices started collapsing. Now, the two reasons for a price collapse. One is there is an oversupply of a commodity, and which means that if the demand is not growing at the same level as there is supply, you will start seeing that as demand starts flattening and the supply is high, the price of that commodity is going to come down. That started happening with housing as well. More and more people, as they were defaulting, felt that they didn't want or they didn't need to have a house. And as the same result, because they borrowed a lot of money from a bank, they said, well, let the bank probably take care of this. What at the end of the day happened was that a lot of banks were left with too many houses as securities, which they had received from those who had taken loans. So now banks were left out with this option to sell off these houses to reclaim their own money. Now you need enough buyers in the market to sell off these collateral securities or these collateral assets, that is houses, to be able to get your money back. So if there are less people buying houses, less investors investing, and you have an oversupply of houses in the form of securities with banks or generally in the project out there, you will see that there is going to be less price that you're going to be able to make, and a lot of houses will go unsold. So one funny encounter between Alan Greenspan and Paul Hansen, who was the Treasury Secretary around that time. It's, I think, now Steve Mnuchin. Steve Mnuchin and Jeremy Powell are the kind of two people tag teaming right now in addressing the current crisis. That time in the 2007 and 8 crisis, it was Ben Bernanke and Paul Hansen. Ben Bernanke had become the Federal Reserve chairman after Greenspan had left. It had been just 1 year or 2 years, I think, as Ben Bernanke had come to become the Fed's chairman. And when Bernanke had asked Alan Greenspan about when the crash was happening, when banks were collapsing, Greenspan said, well, I think there's just an oversupply of houses in the market. And I think one way he suggested to reduce the supply is burn all the vacant houses. And that's it, because if you're trying to sell them, there's very less demand, and anyway that would happen. So it's just one of those kind of out of the box ideas, because the housing market the real estate sector saw this massive crash. Now, as a result of that, what started, and I think this is another chart which gives you a data point on what was happening to privately owned housing as well. which gives you the extent of the problem of how much of household debt or household borrowing in the form of subprime lending had happened to the Americans. So the political messaging was American dream means you need to have your own house. Those who had a house want to get more. Those who didn't have one could get one. And most of this was privately owned, and most privately owned houses and the ownership of privately owned houses started collapsing around the 2006 and 7 period. Now that created this shock effect of those who are providing houses or construction, or those in the construction of private residential housing continued with that, less of demand for these houses, causing the prices of housing and the real estate sector to go down. If I have taken a loan and I'm now paying an EMI which is extremely high, and I'm seeing that the prices of houses are really going down, I would say, why am I paying this high an EMI? And I say, okay, let me kind of not repay my EMI for a few months. And as a result, bank says, well, you've not been paying your EMIs, we're going to put you as a defaulter. As a subprime borrower, I don't care much about the default status because I've defaulted earlier on my debts. And the bank says, I'm going to seize your property, which is basically the security you put, which is, let's say, another house, and sell it off to reclaim my money. And that didn't happen because, as you see, the ownership had come so down that there were hardly people in the market to get a new entity. So as a result, what started happening was household debt, which is the amount of money households owed to banks, started really hitting a skyrocket roof. Now, this has not been a big concern in India because people have generally been seen as those who tend to save and then put their money for borrowings. You don't generally see Indians borrowing excessively in huge margins. This is changing though. I argued a few months ago in a piece for The Wire that if you look at data on credit card purchases, we are getting signals which are very similar to what the US saw, I think, earlier in the 1980s and 90s, which was massive credit card spending by consumers. And that was the kind of the period of consumerism or consumption levels going up. But it's difficult to imagine us kind of becoming the same as the way the American consumer has been in terms of accumulating a lot of debt. This is a problem which is not passed away with the US financial crisis. Household debt in the US is still very high. And that was making more people who didn't have a job to go through the severe trauma, because everyone tends to live from paycheck to paycheck, has incomes where most of your income is going for settlement of debt payments, and whatever little is left, you're trying to manage your household expenses out of that. So imagine a scenario where if you're living from paycheck to paycheck, you lose your job, you lose your paycheck, you don't have insurance, and your debt payments are still there. So this becomes a huge concern. In the post 2007-8 crisis, household debt started skyrocketing. So I think Krugman identifies 6 major causes for the financial crisis. Let me run past them so that you're aware. It's just I think a re-echoing of the points that I earlier made, but just to keep it more structured. The first thing was that a lot of the corporate governance institutions became also extremely greedy or competitive. This includes the rating agencies, which were bottom feeding the credit requirements. This includes Moody's, Standard and Poor. I mean, 2 or 3 major rating agencies which were responsible for putting, let's say, a label of safety on securities that banks had. So banks had securities in the form of collaterals, which are generally labeled by rating agencies to know how safe they are. This is the way to understand that how much of the assets or how much of the loans that you've given is given to people who are safe borrowers, and how many of them are subprime borrowers. So the rating agencies, because of their own kind of internal competition, became or started bottom feeding the credit requirements. So the labeling of AAA, triple B, double B, which are all labels that were put in, AAA being for the safest borrower, double A for the safer borrower, double B for, let's say, a risky borrower, and triple B for the riskiest borrower. all of these started changing to a certain extent. And I think there was a huge collusion between rating agencies and investment banks, because investment banks wanted to lend as much or become as rich as possible from their investments in trading of securities, because they used to, from commercial banks, they used to bundle the securities up, which is the kind of houses that were put as security for by borrowers. So I'm buying a house, and I put my earlier house on a security, and that is with the commercial bank. And the commercial bank would bundle all these bunch of securities that are all houses or pieces of land, and get it, rated by a rating agency and sell it off to the investment banking division. Now, why the investment banker would be interested in buying that? Because then the investment banker can use these bundle of securities which are labeled by rating agencies and sell it off to foreign investors, other banks, and make money out of it. And that's why the exposure of a lot of American banks was in parts of Europe, in parts of East Asia, in parts of other countries as well. And they were all entering into this trade on derivatives. A lot of banking reforms and regulations actually came right after the financial crisis. So banking today looks very different from the world that the banking world was in between 2007. One may argue that what 9/11 did to internal security and generally to security after it's happening, the US 2007 and 8 crisis did the same to banking and financial system right after. There was far more perimetering, or what you call as is a drawing up of territorial boundaries on with respect to regulations on what banks may and cannot do, how much of exposure that can have, how much of as distinction between investment banking and commercial banking, which came with the Dodd-Frank legislation. The incentive structures were deeply problematic, and I think that was responsible for the high degree of income inequality. CEOs were making far more money, so they wanted to continue with riskier investments as compared to the person at the bottom of the managerial pyramid, not making that much of money. And that corporate governance system was seen to be largely, fraught with number of elements. Households were saving little, borrowing too much. That's the point that I mentioned, was in part of the behavior. That behavior has not changed much, even in the post-financial crisis world. The only fact is that if you have a job, you're able to at least pay out for your debt payments. Now, if you have 40% of your people losing out the job, all you're going to have is more frustration. You can see almost that on the streets right now, where a lot of people in the aftermath of COVID-19 have been triggered by, let's say, even issues, systemic issues of racial injustice, but that frustration is out there in so many different varied forms, because you're also there's a context to this context, which is that of high unemployment, high degrees of lockdowns, and this deep-rooted frustration coming out. Politicians slant excessively towards home ownership, and I think that was a big point that the Bush administration, combined with the partnership of sorts with Alan Greenspan's tenure with the Fed, allowed was excessive deregulations, making things far easier from banks for people to borrow loans and live what was called then as the American dream. There's a term here used which is called as ninja loans, which is basically loans which are given to almost strangers, that you don't have background checks for, you've not done your homework much, and this is kind of the riskiest of all loans. Now, the ninja loans were rising and peaking in a lot of counties, and that became, in fact, for those who have watched The Big Short, and if you haven't, I would strongly suggest that you should. I think it's there on Netflix, so those who have Netflix connection, you should watch The Big Short right after probably going through this recording. It's not a bad film. In fact, it's quite funny at the same time. So you'll get a very good perspective on what was actually happening, on the nature of loans that were being given at the local level. Now, apart from that, the last 3 points which were responsible causes included a federal budget, which had a high fiscal deficit. So issues with less revenue, greater spending. That's been the classic kind of Republican versus Democrat divide, that Republicans have often gone in ahead for tax cuts, less of spending on education, healthcare, but more on market forces kind of self-correcting on their own. The ideas of like more of a libertarian economic policy framework, while Democrats have pushed more for greater government intervention, greater government spending, building social and human capital, taxing more so that you have your revenue margin set for. And the fifth factor, which is seen as very important, was that perhaps this was the crisis which saw the most loose or most expansionary form of monetary policy for too long. And this was seen largely under the tenure of Alan Greenspan, and it was almost continued far much under Ben Bernanke as well, that the monetary policy seemed so loose that it was reminiscent almost of the Vietnam era, which was the era where we had a war, and the Americans were almost resorting to a very expansionary monetary policy to move for deficit financing. So if your monetary policy is that loose, that creates often a lot of trouble and makes your economy more vulnerable. This is the kind of the ill effects of an extreme expansionary monetary policy system. I hope you have been able to recollect when I say expansionary monetary policy, what it means. Go back to the rates that we were looking at: repo rate, reverse repo rate, reserve requirements, open market operations, the lending situation. So if your repo rates and reverse repo rates are going down, it's almost giving that signal that there is more interest out there for buying of securities, so that there can be more money can be injected in the system. More money injected in the system gives banks, for example, this leeway of lending out more, people to borrow more excessively. And this has inflationary costs involved, but more importantly, in case of this, many people were doing that to buy more houses. So that was one of the greater factors. And the final element was the underpricing of risk. And I think this is something which is very often studied in financial economics, which is like a subfield of economics as well. For those interested in finance, tend to study this more closely. Is that whenever you're working in a firm, whenever you're working in a corporate entity, you're always trying to identify your risk and mitigate your risk. But in identifying your risk, you're trying to price for risk. So if I'm investing $100, what is the risk element out of this? If I'm investing $100 and I anticipate a risk which is going to lead for me, like the price of that risk is going to cost me $150, that investment is not worth it. So always the effort is you want to price your risk. So why would an investor right now not invest for a big firm investment in the state of Jammu and Kashmir, right? The simple reason for that is if there's a high conflict, internal political instability, territorial issues, it's a state, it's not a state, it's a union territory, how much of supply chain is going to be managed internally. If the risk is priced at a much higher value as against to what the investment is, you would rather not make that investment. So you always try to price for risk and do that. And the concern that a lot of people shared with the 2007-8 crash was that many investment banks were consciously underpricing risk. For this who are interested, and for those who are interested in understanding this problem very closely, there's an amazing film with, I think, Kevin Spacey in the lead, called Margin Call. It tells you exactly what is happening within stock market, within the stock market scenario around the 2007-8 period. And I think the movie tries to project very clearly the crash of Bear Stearns, which was the first institution to collapse, and that led to a crisis, a spillover crisis on Lehman. But Lehman Brothers collapsed, and then it was like a brick of dominoes coming together. But all of these firms and all of these investment institutions were seeing that they were keeping their risk margins, or they were underpricing risk consciously because they were making so much money that they didn't want to look too much at the risk cost. And as a result, higher profitability, higher risks made them more vulnerable to a shock. And that's where, as the housing prices came down, they anticipated or they saw a huge crisis. You see that also in a lot of other shocks. There are crises in the past with the OPEC countries, where if oil prices are falling down, it results in a huge, oil prices are going up. It results in a huge import bill. And if you're not anticipating that and you're hugely dependent on certain countries, that may, so oil countries which are exporting and have a higher price may really benefit out. But right now, for example, as oil prices have started crashing down, countries like Venezuela went bust, or almost insolvent, because most of the revenue was coming from oil. But think of even countries like Saudi Arabia right now. Oil, for the first time in, I can almost think of last 100 years, is almost a zero and negative. So their old revenue was largely coming out from those exports. So if you, there was, in a case of a crisis like the current one, no amount of risk modeling will help you anticipate this much of a, a shock. But at the time of the 2007 and 8 crisis, there were markers as a result of which people were able to identify that there was a crisis on the horizon if you kept on deregulating and you kept your monetary policy and fiscal policy so loose. Okay. Let me come to the last point of our discussion, which is which started developing a lot in, I think, the post crisis aftermath. And this is very similar to what was being seen in the post Great Depression aftermath as well, which was on the very kind of, knowledge and wisdom of economists. If economists think that they're so smart, why were they not able to predict this crisis? The same question even the Queen asked from economists back at LSE, that if you think that you're so smart, you were not able to even predict this crisis and the impact of this. So there's a certain degree of, anti-intellectualism that tends to crop up post a crash. You see that happening across the board. The Wall Street movements, the movement which was to kind of anti-elite movement that tends to happen, often sees that the intellectual class, which is now almost seen in resonance with the elite, is not very much aware of the set of issues on the ground. And a lot of people felt that right after the crash, because there were already very high systemic income inequalities and wealth disparities present, which exacerbated to a very high level after the crash. So a lot of people ask this question, that, what do economists think, and what is that? So there's this amazing, line that, or I would say few lines that Keynes writes in his magnum opus and his kind of most influential text, about the ideas of economists and political philosophers. And this is just, I'll read this out, and I'll just, imagine the kind of powerful imagery that Keynes strikes then, and which has such a strong resemblance to even now. The ideas of economists and political philosophers, both when they're right and when they're wrong, are more powerful than is commonly understood. Indeed, the world is ruled by little else. Practical men or women who believe themselves to be quite exempt from any intellectual influences are usually the slaves of some debunked economist. Madmen in authority who hear voices in the air are distilling their frenzy from some academic scribble of a few years back. I'm sure that the power of vested interests is vastly exaggerated compared with the gradual encroachment of ideas. Not indeed immediately, but after a certain interval. For in the field of economic and political philosophy, there are not many who are influenced by new theories after they're 25 or 30 years of age. So that the ideas which civil servants and politicians and even agitators apply to current events are not likely to be the newest. But soon or late, it is ideas, not vested interests, which are dangerous for good and evil. So, in kind of short, there is this discussion which often makes that if you're not investing yourself in ideas that try to challenge the existing knowledge or status quo, you're always kind of more succumbed to vested interests, politicians, and there's a certain distance that you tend to have from reality. So Keynes' argument seems to be more in terms of having a conscious effort to work on ideas that are more resonance with your practical lived experiences, right? As compared to a lot of economists kind of going back to the past wisdom to looking at what it is. So let me probably end with a final lecture and with a final set of thoughts, asking this very existential question that after what 14 or 15 weeks of sessions, and after a horrifying kind of semester with so many virtual sessions and assignments and talks, of what use is a subject like macroeconomics. I think the three important uh, elements to that: macroeconomics in its real core essence is a subject, or is a field to really understand what factors can help you prevent or minimize the effect of an economic crisis. How can you be best prepared to manage a crisis, and what could be your response measures? It's like, we're almost playing the role. When I say we, I'm not trained as a macroeconomist per se, but I'll say, because I'm teaching the course, I'll represent myself to be probably part of the league there. But the idea is that we're largely seen as weather men or weather women, mostly trying to depict when is the next cyclone likely, what are the indicators that help you understand where that cyclone is likely to take a landfall, how can you be better prepared to evacuate people, how early can you do that, because the earlier you're able to indicate, the more quickly you can take those evacuation measures. And if the cyclone hits, what kind of response measures can you take? These are the kind of factors that macroeconomics at the very least can help you understand. And for each one of you, I think the very important question that you have in front of you is basically a set of these three questions: what is going on in a repressed or in a recession economy? There is no perhaps better time to ask that question than now. What is happening to the state of the Indian economy today? What is happening to the state of the American economy now? What is happening to the state of the Chinese economy now? Borrowing from Keynes, how is that our possibilities of wealth may run to waste for a time? What set of policies that, if we continue to undertake, will make our situations far worse off over a period of time in the long run as against the short run? What elements are important that in fact are critical for us to help understand that what leads to a crisis, right? That precede a depressed economy. These are the questions that you need to, or you ought to remember, address, and think about as you move forward. And with that, I'm not here to provide you answers, but basically put these questions out in front of you and let you make the choice on which direction that you're more interested in. I think, and then use a pathway to. This is an introductory course in macroeconomics. You may have interests that are very specific within the course in the light of what you've seen. And I think I'm more than happy to kind of later on have discussions, and hopefully as most of you guys are back on campus, you can always be to connect to see what areas that you're more interested in reading about. I've already mentioned there are two courses that I tend to take, which is one is in the course of Brief History of Economic Crises. If you're more interested in looking at issues around economic crises, you can probably take that up. The other course is a course on political economy of late development. That looks largely at the relationship between state and market. And that's a course largely coming within the domain of political economy, but it also looks at the economic state of affairs. Our focus of most of our discussion is on India and China in that course, apart from few other emerging countries like Nigeria, South Africa. All right, with that, we come to an end, and I would like to thank each one of you for very patiently, diligently working hard throughout the course term of this term. I, at the same time, would want to probably take the opportunity to apologize for anything that may have caused you inconvenience or discomfort. But as all of you know, these are very testing times for all of the administration. I mean, I would say even faculty members, students. So I'm happy with the way, at least, how we've been able to take this road down the line to address this crisis together, and almost use this as an opportunity of learning. In fact, there is no perhaps better time than a crisis that is happening right in front of you to be able to maximize your learning potential from. And I know it's easy, it's easier said than done. A crisis often tests everyone psychologically, emotionally, intellectually. But if you can control it, take a better control of yourself and keep yourself in command on things, there is a tremendous possibility of learning. In fact, I would say The past 2 months have taught me and made me learn things perhaps in the most granular, minute details as never before. And I think I guess that's the same for everyone. So what I would say is, I mean, you guys probably have 1 or 2 more weeks of just term time left. The submissions, assignments, get done with it. I think perhaps take this few days of time to get yourself back in, in order, and use this time and use this energy to learn something that you consider you would otherwise not be able to learn. Invest in your own self, invest in your own capacity, because you want to come out of this entire crisis um, in a very imagined manner. Now that could be for good or worse. A lot of people may come out, totally depressed and losing their minds out of this, but that doesn't do you any good. You won't have people all the time available to listen to what you're going through. Sometimes you may call up people and they'll respond to you and listen or hear you out, but everybody is going through their own situations. So what you need to do is basically use this as a learning opportunity to learn as much as you can. Not learn by absorbing tons and tons of digital information, but learn through observation, learn through experiences of others, and learn through conversations and interactions. That's the way you actually tend to learn far more. That's the way research happens. That's the way a lot of things that in academic discussions tend to evolve. So engage more with people. Don't isolate or alienate yourself out. Do that as much as you can. uh, Pick up a certain instrument or a skill that you feel you want to do over a period of time that can help you come out of this whole situation, and you feel at least, all right, that was one of my biggest learnings from the entire thing. I was able to, could be anything. I mean, some people like writing, some people like drawing, some people like art or craft, whatever that may be. So with that, I will bring our long interaction for today to a close. I would strongly urge you not only to look at this lecture recording and presentation to have a better understanding. I think the presentation is already up on the NB platform, but also watch these two films I mentioned about, The Big Short and Margin Call. I think both are available on Netflix, so you can probably take a look and get a better hold of things. We'll have a discussion on the lecture on Monday. So we meet on 8 at 8 a.m. Monday. The camera is on for our last live interaction. Till that time, just take care of yourself and we'll meet soon. Thank you.